So hello class again, and welcome to this particular video. And in here we're going to be focusing on chapter 4, which involves working with financial institutions. And in here we notice that there are various financial institutions that help us to do the following, and all these interesting finances that will be explored is mainly dealing with you and the bank. So the bell work for today is that in here our goal is specifically looking at exploring different accounts that actual customers open in a bank and writing a check. I know now we don't write checks anymore, or it's not as prominent as it used to, because now we have a lot of electronic means by which people send money to another person, and all these actually are influenced by the changing in this particular landscape. And the next one is how to manage credit card, and this is really important because you need to be able to keep track of that, which is really instrumental for various financing that may actually occur not now but in the future. So building your credit or limiting the use of credit cards may be beneficial, or will be beneficial if you're prudent in how you use money. And finally is how to read and interpret statements, either being a debit statement or a credit statement. So now let's look at the keywords that we're going to explore. We're going to explore accounts and debit card, and this will lead into a checking account, and also how this is included into the savings account. And all this combination leads to routine transactions that actually comes up to your account balance, and all these actually are influenced mainly dealing with how you use ATM, which is the automated teller machine that you see in various areas as a result of the routine transactions that the bank are trying to promote. And others includes taking money in cash through that machine, and or using checks, either or using e-transfer, which is electronic means of transferring money from one particular person to another, or from one institution to another. And overdraft protection deals with how you use your check. There are various limits by which banks actually allow you to use your account past how much is present in that bank account, and that is what that means. And NSF checks involves when you don't have sufficient amounts that is available for you to execute a transaction, that will be inhibited, and you won't be able to actually successfully promote or successfully complete that transaction. So your check will be sent back to you through that particular means. And finally we have a post-dated checking, where in this case you're going to put in that check for a specific future date when that money will be cashed. And finally we'll be looking at check or credit card, So now let's look at how those words fit into a mind map. So first off, if a person goes to a bank with a huge sum of money, the person's goal is to be able to open accounts to put that money into a personal account. So this is the chunk money, and one way of creating an account is through the use of a debit card. So a debit card will be introduced or will be passed on to the customer by the teller, saying that hey, all your money is in this particular card electronically. What you have to do is just log in, and then you'll be able to access the electronic version of that huge chunk of money. So this debit card is actually divided into two. One is actually the savings account, and inside also we have the debit card to contain the checking account. So the checking account, usually there are actually zero interest included or added to that particular money. So as a result, pretty much the monthly, I would say, charge will be based on the use of that particular card. So particular banks do actually charge a monthly rate depending on how you use that particular card for various transactions. And for savings account, usually get between 0 to 5% interest added to that savings in a year, which is, I think, will pay off down the road, but it's not as huge as other types of savings account. And all this actually leads to one important thing, which is routine transactions. So the more routine transactions, if you exceed the routine transaction, there could be charges that the bank will actually introduce into your particular bank account. So various ways or avenues by which banks actually introduce a routine transaction is either through one, ATM machines, which is also called the automated teller machine, where you can just go in, put your card or insert your card, and you can withdraw any amount of money in smaller amounts to actually do some specific financial task or duties that you want to do. And another method by which routine transaction can be established is by e-transfer or interact. You can just tap your card. That is easy for you to spend your money in that particular way, or to pay for a specific item or service, and this is actually done electronically or online in that particular case. And it's pretty convenient, that I can see, way convenient than writing a check and sending it to a specific person. And finally, here is a check, and a check is more of a manual way of representing money, and you can actually fill out a check, and there are various cases that may actually happen when you complete writing the check and you send it to the teller for that particular receiver to cash that particular money. One thing is that sometimes if you don't have sufficient money in your bank account, but the check has more than what you have, an overdraft protection is actually established, where you can actually take more than what you have in your bank account in order for you to actually execute a specific transaction. Otherwise, if you don't have that overdraft transaction, you'll be left with an NSF check, which means that your check will be bounced back to you. You won't be able to actually, or you will have an incomplete transaction where you won't be able to perform that specific financial duty that you want to promote in there. And finally, here is a post dated, which means in here you're going to put that check to be withdrawn so that you'll be able to withdraw a specific amount of money on future dates. This is usually done electronically as well when it comes to pay dates. After a specific pay is actually established, the bank will be like, okay, on the Friday this money will be automatically put into your account, and that is actually an example of a post-dated account, which is on the future you'll be able to actually get your money from that check's date. So that is it in here, and all these are really a big summary on how huge chunk of money are actually used up in smaller amounts using those routine transactions. And all the combination of your savings account and your checking account leads into your overall account balance, which means that after all the spending, after all the investments are made between or with a combination of both your checking and savings, what is left is called the account balance. How much is left after all those transactions are actually established or completed. So now you have this actually taken care of, we're going to make a connection with the account balance to the other way by which an account can be created. This is one that is quite tricky, and you have to be prudent while spending that money. So in here we have credit cards, and credit cards are actually in various forms. Sometimes you see that in terms of a MasterCard or Visa, American Express or Discover, and what you notice is that all these guys, they have one thing in common, which is that the bank actually introduces a loan method for a particular customer to actually spend money. But there is a good and a bad thing behind this. The good part of it here is that there is actually money limits that is assigned in here. Like for example, if you're given a card, the money limit or the money that's in there will be, for example, $100. So what that means is that as long as you're within that particular $100, you can spend that particular card on a specific item that is less than $100. And what you have to do is to pay back, and once you're able to execute that payment of that particular item using your credit card, they have to be within that particular money limit. So if you are within that $100 money limit, and you're able to actually pay back using your account balance from either your checking account or your saving account, you will be able to actually increase various rewards or points that a particular credit card is actually investing or is actually promoting to you. So all these are ways by which you actually build your credit, and by building your credit either by rewards or by points, you can be able to actually do some interesting big transactions, like for example getting a house, because the government will be like, hey, do you have a good credit? Yeah, because they see that you're paying back the money that was loaned to you. All these transactions and payment or repaying of your loans actually shows that yes, you are mature or comfortable to actually handle bigger finances, like for example paying mortgages to buy a house and stuff like that. So this actually is unfortunate because some people are not able to actually get this particular benefits on the right track, which means here that there is a disadvantage behind this. So if you exceed the money limit and you don't pay back the money that was used on that credit card, you will be charged interest before the date if you don't pay before the due date, and the interest could go as high as 10% to 22%, and this is actually when you exceed the money limit. So therefore, if you don't pay that money, this could lead to some huge unfortunate circumstances, like for example the bank will send your money to the collection center, and if you don't pay for some specific month or years, they could send that money to a bankruptcy, or you could file for a bankruptcy if the money that you're owing is so high that you can't actually pay back. So what I would advise you do is be prudent. If you think you're mature enough or you're financially stable enough to actually hold a credit card or own a credit card, take advantage of the rewards and benefits when you're paying back those money that you used from that particular credit card, and try to avoid this particular exceeding part where you're not able to pay back that particular money. So now you have this mind map actually established already. We're going to look at closely the check and how to fill out a check. So a check looks like this, and in here the first thing you see is a name and that particular address. That is actually the sender's name and the address, and this section here tells you that hey, we have a check number. It could be check 1, check 2, check 3, check 4. So it depends on the checkbook. The amount of checks in that particular book is assigned by that particular number, and then this here tells you the date that that check is actually written to that particular receiver. So the name is actually written down in that particular role, which is the full name of the receiver. And the next line here tells you that hey, you have to write the dollar amount in words and the cents amount in number. And once you have that, your next step is to write the numerical amount, which is either in dollars or in cents. And then the next one here you notice is the bank institution or the financial institution that this particular sender is associated with. And once you have that actually established, you actually have the memo, which is the brief information about the reason why you're sending that money to the person. Is it because you're paying back the person for a specific product? Like for example, hey, I borrowed the money to buy a shoe. You can just write brief information, shoe, right there, and that is the reason. It keeps track basically on this sender's finances in there. And finally here you have the sender's signature written below over there. So other key information that you don't need to know, or if you need to know, is all these bar numbers at the bottom here. We don't really care too much about this one there, but we do care a little bit about this. This one here is the branch or the transit number that is mainly related to the address or the specific location of that particular financial institution branch. And the next one that is follows is the financial institution, which is, for example, RBC. In this case here is Scotiabank, and then the next one here is the sender's account number. And once you have that actually established already, just key information. You don't need to know or memorize those numbers. We don't care about those, but this is just for the bank so that it can go into the right location at the right time. So that is it in here. I'm going to look at various examples here to keep in mind of. Now in here we have an example that deals with filling out a specific column that has all this information right here. So column B tells us that there are terms that matches with the various blanks in column A. So looking at column A, the first question says that you can get a cash you need out of your bank account by using one of those on column B. So looking at column B, you should recognize that yes, it has to be done through an automated teller machine, and this ATM machine will be used for you to get your cash back quickly and avoid you going to the teller directly and getting the money in cash. Now the next question here is, Alex wrote a blank when he bought a soccer ball at the spot check store. So this, you will know right off the bat, is you can actually write a check, because definitely that has to be done. You don't want to write on a bill or on a note, because that is pretty much, I know that is illegal, but I think that is not really the right place to write any financial statement. So next one here is, immediately this spot check store owner drove to the nearest RBC bank and blank with Alex giving them what Alex gave them. So in here you know that, of course, after you write a check and you give it to the receiver goes to the bank and cashed out that particular money. So that is how it is done. A sender gives check to the receiver and the receiver cashes out that particular money in the bank. Now next one here is post-dated checks, and in here it means that on a future date you will be able to cash a specific check or write a specific check to a specific person. Like in here it says Nathan pays for a rent in May with 8 what. So it means here that on that particular future date, the post check will be actually cashed out, and it's kind of cool in that particular sense. And next one here is, it is a good idea to write each withdrawal and deposit in your where, and then calculate your blank. So the first blank here is every transaction that you actually do on a bank has to be recorded either by the organization or by you. So it's always a good idea to keep track of these, so by the end of the month you'll be able to look back and see your expenses and how best to actually overcome various inhibitions concerning your spending habits. So that is it in here, and the final one is your account balance. So this account balance is actually the summary, or is the sum of all the transactions that you've done, and what is left is actually the money that is a combination of your what is left in your saving account and your checking account, and the combination of all the money left leads to your account balance. So that is it in here, and the next question here is looking at the various interest rates in the table. This table right here, we have interest rate that is 0%, 0.6%, 5%, 19%, and 29%. We're going to look at various accounts and see which ones fit into those specific account interest rates. So in here we see that what interest rate do you think checking account likely pays? If we look at the first minute of our video or the first 6 minutes of our video, we said that yes, it is 0%, and for B we saw that for savings account we notice that it's between 0 and I'll say 10% or 5%. So in here I'll give it 0.6%. And then for C here, which involves a bank check card, and this is when you exceed that particular date and you're asked to actually pay the interest. So the interest that the bank is going to add into your credit to make it harder for you to pay back is around 19%, which is really huge. So you want to avoid the bank adding 19% to your particular credit card, so that you will be able to actually reap great benefits from the credit card company in there, and maybe in the future you'll be able to own a house because the credit your credit is really good or great. So that is it in here for that specific differences between getting a debit card or getting a credit card. And don't forget, under the credit card you need to understand the limits and not exceeding the overdue date. However, for the debit card you want to be aware on the checking versus savings account and how much percent is actually included into your account under the debit for you to actually become financially stable. So in here we're going to look specifically at credit card, and we're going to have a question that goes like this. It says here, your brother giving up a specific amount, which is $200 for your graduation after party. Now the question says, which would you rather do with the money? Will you rather spend the money, or will you rather put the money in your savings account, or will you pay down your credit card balance? So thinking about this question, I want you to think about this hierarchy of spending. In here, this actually tells you an increase in urgency, which one is the most important money to take care of first before you actually go into spending. So spending, of course, is the least urgent task to actually implement, and then the one that you want to focus a little bit more on is putting it in a savings account. And finally, the one you want to take care of the first is offsetting all debt or loans, which is, in this case, you have to pay down your credit card balance first. So if you don't have a credit card, that is awesome, because all you have to do now is just deal with savings, which means you have to save more money so that more percentage will be added every year, and that could increase definitely your financial status. And finally, if you have sufficient money to do other things, is finally here to spend that particular money. So the top priority is credit card, second priority is savings account, and the last priority here is spending. So this is a little bit of a summary on how you should focus your mind on spending money or offsetting all debt. So in here, the next one here is focused mainly on credit card, and in this question we're asked that green boasts to blue, which is another person, that it had 4 credit cards. What? Who owns 4 credit cards? Well, I know people own 4 credit cards. They're able to keep track of that, but me personally, I'm not really good at keeping track of that many credit cards. So that is interesting. So the question here says that, do you think that this is something to boast about, and explain why or why not? To me personally, if I'm the one that owns 4 credit card, I won't say that to someone else, to be honest, because it means that I'm actually taking more liability, and I want to be able to have less liability and keep track of that particular liability in order for me to be more financially stable. So in here, to be honest, I will not actually talk about, oh, I have that much credit cards, but rather I will say I have that much investments in the bank. That is something you want to boast about, because that is something that is so much more beneficial and profitable down the road. So in this here solution is no, it is hard one to keep track of all balances, because in here you have 4, not 1 or 2. I can't even keep track of 2 alone. Come to think of 4 credit cards. So spending, because if you're spending from one credit card, you might mistake that one credit card for another, and if you're trying to balance that particular credit card, it means you have to go through 1, not 2, not 3, but maybe 4 credit cards to check that, hey, I actually spent money on that credit card, so I have to pay back that particular money. So you want to think around this particular setting and which one is best for you for now financially, so that the future will be bright. So that is it in here for credit cards. In here we're asked that you're asked to fill out a check to pay a specific person after you bought 7 DVDs, and one DVD costs $2. So if we have a check that looks like this, we have all these particular things actually displayed. We have the date, we have the paid to the person, we have the order in terms of writing the amount that you're going to pay, you have the memo, the reason why specifically you're actually paying that person, and you have the $sign which tells you that, hey, that is the numerical number for that particular money. So in here, first thing and finally is the signature. So in here, first thing you do is write the date, and then the second thing you do is write the receiver's name, and then the third thing is to calculate how much you're owing that particular person. In this case, we know that we bought 7 DVDs and one DVD costs $2. That means 7 DVDs costs 7 times 2, which gives us 14. So that means that I'm going to write the numerical value 14. I'm going to write the word value 14 because it is in dollars. So in here I'm going to write the word value right there, and I've written down the numerical value over after that $sign on that particular blank. So that is taken care of, and the signature of the sender will be written or done right below the check blank, and the memo, you can just write, oh, DVDs if you want to. You don't have to, but I would advise you do if you want to keep track of your financial spending. So that is it in here for writing a check. And finally here is dealing with a credit card statement, and usually at the end of the month the credit card company or the bank sends out a particular statement to the specific user, and usually you're given the date by which you've actually made transactions with that particular credit card. So all these will be recorded and will be sent out to you, and these are the 3 transactions that are actually done. We have Jerry's Garage, which costs that particular amount, and you made a payment to your credit card which is $200, and finally you have an interest charge which is $16.65. So based on all these transactions that were actually made on your credit card, all these are the breakdown of what is due and how much is left. In here you have the overdue balance that you will have to figure out where it is. They have the interest charge that the credit card put into your bank account or your credit card that you have to pay, and then you made a new purchase which is the Jerry's Garage, which is that specific amount, and you have a new balance, and then you have your minimum due payment, you have the due date for each transaction. Otherwise you will have to pay that specific interest charge. And then you have in here the annual interest rate, which is in this case for this particular credit card is 18.9%. And then finally here you have the available credit, which means that if you combine that available credit to the new balance, you will know the specific money limit. So let's look at the various questions in here. So the question here tells us that in here, what are the three items that are added together to make the new balance? So first thing is that we want to know the new balance, which is right there. So once we want to know the new balance, all we have to figure out is what are the things that, or the money that has to be combined together to give us what is actually used in the credit card. One is the overdue balance, and the overdue balance is right there. And then the next, looking at it, is the interest that is added to that particular credit card. And then the next one here is, and finally, the new purchase, which is right over there. And all these three, according to this particular statement, is combined or added to give us the new balance. So the next question here is, one, what is the overdue balance, which is what we have right there, and what is the new balance? So overdue balance is right there, which is the blank, and the new balance is what we have on that particular asterisk right there. And we're going to look at calculations on how to solve the overdue balance first. And to do that, we need to combine the previous balance with payments that you actually made. So if you are owing the credit card 979.2 or 0.20 or 27 cents, and you pay $200, what is used in the credit card is that you have to subtract $200 from the previous balance. So once you have that, you'll be able to determine what is actually used in your credit card. So in there, once you have that taken care of, you write that down. And for our new balance in here, we'll have to actually add not only the overdue balance, but the interest rate that was actually added to the bank account or the credit card, and finally the new purchase. And once you add all those together, this is how much you've used out of your credit card in that case. So you will have to pay back that money for that particular credit card to be actually on a good standing, or you must have a good credit score in a way. So all these are one of the things you need to keep track of in your bank statement or your credit card statement. And finally here is, what is the credit limit? Credit limit here is a combination or the adding of your available credit and your new balance, which in this case is this particular money and that particular money available credit. So the available credit that is left is $1,887.73, which means here that available credit is how much you still need to spend before exceeding the credit card limit. So if you add that to how much you've spent already from the limit, which is the new balance, $1,112.27, you will be able to get the credit limit, which in this case here is $3,000. So $3,000 is a credit limit that the credit card company has given to you, that you have to spend this money, and you can spend within that particular money from 0 to 3,000. So once you're able to do that and maintain that particular limit without exceeding the overdue payment and paying back before the overdue date, then you're good from there. So this here, 3,000 is the credit limit. And finally here is the question saying that Pink, which is the owner of this particular credit card, has $1,056 in her savings account. Now this savings account, don't forget, is under the debit card, not the credit card. So now we know that the person earns 1% interest per year, which means that after 1 year, 1% in dollars is actually added to her debit card, which improves her financial status. Now the question here tells you that what would you advise her to spend the money on her credit card bills, and explain why. So to me personally, I think honestly you have to actually pay the credit card as much as possible, and this will be able to be done for you to reduce the interest rate that may be introduced if you somehow forgot to pay before the due date. So it's really important to be able to recognize that, hey, I have to pay the credit card company as quickly as possible, otherwise if I exceed the overdue date, I will be charged interest rates, which is a huge amount of money. So that is about it for this particular video. Hope you're able to understand this. Please hit a comment down below. Let me hear your thoughts about all these that we actually explored concerning financial investment and working with financial institutions, mainly there with debit cards and or versus credit cards. All the same, hit me in the comment section or send me an email if you have any questions. By that way I can talk to you all soon. Stay smart and believe in yourselves.